Well, we've set out today our strategic update. So we're giving targets and strategy for the medium term, and we're targeting 8% returns in 2024, as you mentioned. I think in the intervening years, we expect to recover because the economy is still tough, interest rates are low, so I think it will be a gradual recovery through 2024.
I hate to hark on about another bank's outlook view on you, but I mean, one of the arguments they make for a better 2021 is largely this one around pent-up demand being released by a vaccine that is comprehensive and successful in Western countries. As you look at your updated numbers here in this release today, how key is it that that pent-up demand does unfold through the early part of next year?
Well, we've based our outlook on quite cautious economic forecasts. I think we all expected a vaccine would come through next year. It will be helpful to our clients, our corporate clients and our retail clients, because we're seeing a demand for loans today really quite muted. People are cautious, both consumers and corporates. So I think as the vaccine, if and when it gets rolled out, it should improve confidence, and you'll see increasing demand for loans, which will support our income line. I think we need to balance that against the very low interest rate environment. And over the last few years, and in particular, since the pandemic started, we've seen very low rates, and low rates aren't good for banks, so that will hold back our earnings. So you'll see the balance of those two factors. But banks, as you know, are economically sensitive. We've been hit on the downside, and if there's a good recovery, we should benefit on the upside.
Clifford, can I ask you about the dividend? We're all watching those announcements very closely, and you've made a comment today that payout of the accrued full year 2019 dividend will be considered prudently at the full year 2020. Just give us a sense of some of the thinking behind the scenes about that payout to shareholders.
Well, today is our strategic update. We made that statement also at our Q3 results a few weeks ago. Not a lot has changed. The things that we would reflect on when we come to consider dividend at the end of this year, the full year 19 dividend, is, as you mentioned, the ECB's recommendation. Currently, the ECB is recommending banks in Europe not to pay dividends. We'll also reflect on the economy, the state of our business, and the outlook. So while we see the prospect of vaccine economic recovery is hopeful, we're still living in uncertain times. So we'll weigh those up to ensure that the bank stays strong and resilient through these uncertain times.
Clifford, good morning to you, my friend. Look, I want to get this point off my chest as well. You talk about the demand for loans and sluggish and how excited you are if they increase economic activity and the NIMs can improve as well. There's nothing wrong with loan demand in Europe at a government level, at a household level, at a non-financial corporate level. On the last one, for instance, 114% debt to GDP as opposed to 108% a year earlier. On households, 60.5 in the euro area versus 57.7. Loan demand is going up precipitously. It worries me that more people who don't need finance are being encouraged to go and get finance, and those that do need finance, quite frankly, some of their balance sheets look awful, Clifford.
I think you've got to look at different segments, different countries, different economies, frankly. So there's quite a wide range across Europe. So in our home market in the Netherlands, there's quite a lot of mortgage debt out there, but there's also quite some real estate value to back it up. So we lend cautiously to the consumer. The consumer market here is pretty prudent. I think the point I was making earlier was around the corporate sector. And so we've seen demand for loans from corporates actually quite muted in the Netherlands and our core markets in Northwest Europe. And I think that's different from some other markets in Europe and globally, where you've seen very, very strong demand, for example, government guaranteed loans. Here in our core markets in Northwest Europe, actually demand for government guaranteed loans has been relatively modest because the corporates are well funded and they're concerned about low demand. So I think as demand improves, you'll see that lending volume pick up.